Good day, Junior Tikkies. I'm Mrs. Brimacombe. We're going to look now at activity 3. This activity is going to focus on identifying which account is involved in each transaction and how that will influence your assets, owner's equity, liabilities, income, or expense. Before you start this activity, a reminder, go through the accounting theory booklet and understand exactly what do we talk about when we talk about assets, owner's equity, liabilities, income, and expenses. What do we talk about when we're talking about the double entry principle? For every debit, there is a credit. And understanding, but on which side will it increase or decrease? On the debit side or on the credit side? Question 3.1. Complete the following statements by filling in the missing words in the list below. Question number 1. The left-hand side of the general ledger is known as the debit side. The right-hand side of the general ledger is known as the credit side. Number 3. All income will have a positive or positively affect the owner's equity. All expenses will negatively affect the owner's equity. A reminder that we have direct and indirect owner's equity accounts. When we're talking about direct, we're talking about capital and we're talking about drawings. Indirect refers to all income and all expenses because it affects the owner's equity. Question 5. The double entry principle states that for every debit entry, there must be a corresponding credit entry. If you think about that, when we look at a transaction and we're looking at cash transactions only, it means that the business received money or the business made a payment. So when the business receives money or the business makes a payment, that money will always be deposited into our bank account. Payments will always be made from our bank account. And now we need to identify, but why did the business receive money? Why did the business make a payment? And that is the business account name that you need to identify. So before we can proceed to identify how it will influence your assets, owner's equity, liabilities, income, and expenses, it is important to understand that when we look at assets, assets will always increase on the debit side and decrease on the credit side. Owner's equity minus plus, liabilities minus plus, income minus on the debit side, plus on the credit side, and expenses is plus minus. This is something that you need to study. A tool that you can use to help you remember this is by looking at the word date click. Now, if we look at date click, the D stands for debit, E, expenses, A, assets, D, drawings, C for credit, L, liabilities, I, income, C, capital. And if we look at debit side, all expenses, assets, and drawings will increase on the debit side, which means it will decrease on the credit side. If we're looking at credit, liabilities, income, and capital will increase on the credit side, which means that it will decrease on the debit side. So this is just a tool that you can use to help you remember. When we're talking about increase and decrease, where does it increase or decrease, on the debit or the credit side? This is what you can use to help you remember. Question 3.3. Read each transaction carefully. Which business account will be debited and which account will be credited in each transaction? So this is applying the double entry principle, identifying which account is going to be debited and which account is going to be credited. And the second part of this question, how will each business account influence your assets, owner's equity, and liabilities? Indicate on which side it will increase with a plus or decrease with a minus by completing the T account. And now you would notice, if we're looking at owner's equity, there's no income and expenses, but you need to know that your income and expenses has an influence on your owner's equity. So that is what we're going to practice in completing this question. Here's an example. The owner gives a further capital contribution. So number one, identify which two accounts is involved. That will be bank and capital. Now, something that you need to remember. When we're talking about cash transactions only, the bank will always be debited when the business receives money. And now we just apply the double entry principle, which means the rest will be credited. If we're looking at if a business makes a payment, bank will always be credited. And the rest, apply the double entry principle, will then be debited. So this is something that you can study. Use bank as a basis to work from. And then you just apply the double entry principle. And now we can indicate the influence. Bank is regarded as an asset, which then will increase on the debit side, and owner's equity. Capital is a direct owner's equity account, and that will be plus on the credit side. So this is how you need to practice this. T accounts is a tool that we can use in knowing exactly should we debit or should we credit. Purchase A4 printing paper. So when we're talking about printing paper, the account name involved is bank and stationery. So when the business makes a payment, it means that your bank account will always be credited. What did we purchase? We purchased stationery. Now we need to classify these accounts. Stationery is regarded as an expense, which will influence your owner's equity. Your expense will increase on the debit side, which means that will negatively affect the owner's equity. The more your expenses, the more negatively it will influence your owner's equity. Bank is regarded as an asset, which means that your assets will decrease. And where does it decrease? On the credit side. The owner drew cash from the ATM to purchase a cover for his tablet. So when the owner drew cash, and this is for his tablet, it means that money was taken from the business. Bank is involved. Why was money taken from the business? This is a personal expense and will be shown as drawings. So when the business makes a payment, bank is always credited, the rest is debited. You're going to hear me say this many, many times. Now we need to classify each one of these accounts. Drawings is regarded as owner's equity. It's a direct owner's equity account. And bank is regarded as an asset. Your owner's equity will decrease and your assets will decrease as well because money went out of your bank account. Paid the employees their weekly earnings. Account debited, wages, account credited, bank. When the business makes a payment, bank is always credited. The rest is debited. Wages is regarded as an expense, which will have an impact on your owner's equity. It will influence your owner's equity. If your expenses increase, it will have a negative effect on your owner's equity. Account name credited, bank. This is regarded as an asset and your assets will decrease. Paid the owner's personal end-to-end cell phone account. Again, it talks about the owner's personal end-to-end cell phone account. Anything taken for personal use is shown as drawings. So drawings is going to be debited, account credited, bank. Why? Because money goes out of our bank account. It means bank is always credited. Drawings is regarded as owner's equity, which means our owner's equity will decrease, and bank is classified as an asset. Our assets will decrease as well. Paid for the advertisement to be placed on social media. Advertisement means that we've paid for advertising. This will be our business expense and money went out of our bank account, so bank will always be credited. The rest is debited. advertising is classified as an expense which will influence your owner's equity. If your expense increase, it will have a negative effect on the owner's equity. Bank is regarded as an asset, which means your assets will also decrease. Received cash for consultation given to a customer. So when you give a consultation to a customer, you are rendering a service. Money has come into the business, so when the business receives money, bank is always going to be debited. Now, very important, services rendered. Our main income from services rendered is called fee income, or another word that you can use is current income. If bank is debited, it means the rest, which will be your fee income, will be credited. Bank is regarded as an asset which is debited, therefore your assets will increase. Fee income is regarded as an income, but this will influence your owner's equity. If your income increases, it will have a positive effect on your owner's equity. It is so important to understand the effect that your income and expenses will have on your owner's equity. If we look at transaction paid, the next transaction, paid to have the business rooftop repaired. Again, this is the rooftop that we've now fixed. We've repaired that. That means repairs, which is an expense, is going to be involved, and bank, because a payment was made. If a payment is made, bank is always credited, the rest is debited. Repairs is regarded as an expense that will have an effect on your owner's equity. If your expenses increase, it will have a negative effect. Bank is regarded as an asset because we have a favorable bank balance. And now, if money goes out, it means that balance will decrease, your assets will decrease. Purchase a scooter for deliveries. A scooter will be regarded as vehicles. Remember that our non-current assets consist out of land and buildings, vehicles, and equipment. So if we purchase a scooter that we're going to use for deliveries, that will be shown as vehicles. And if a payment is made, it means that bank is involved. So now, vehicles is regarded as a non-current asset, and bank is regarded as a current asset. This means that vehicles will increase our assets and the money going out of our bank account will decrease our assets. Paid our employees their monthly earnings. When we're talking about monthly earnings, we're not going to show this as monthly earnings. We've made a payment, so money went out of our bank account. For what reason? For salaries. So bank will be credited and salaries is going to be debited. The influence, salaries is regarded as an expense, but it will have an impact on your owner's equity. So if your expense increase, it will have a negative effect on your owner's equity. Bank is regarded as a current asset, which means that our assets will decrease when money goes out of our bank account. Purchase a new multifunction printer. Now don't get confused. When we're purchasing printing paper, that is regarded as stationery. But now we've purchased a printer. That printer is going to be shown as equipment. This is a non-current asset and money went out of our bank account. So if money goes out, bank is credited, the rest is debited. Equipment is regarded as a non-current asset and bank as a current asset. This means that your equipment that you've purchased will increase our assets, but the money going out of our bank account will decrease your assets. So assets is plus minus. Invested money into a fixed deposit account at Lex Bank for a fixed period of 24 months at an interest rate of 16% per annum. So when it's given to you in this manner, you need to be careful. They said that we've invested money. So we took money out of our current bank account and we've put it into a fixed deposit. Now they just said for which period, that is for 24 months, and the interest that we are going to generate from that will be 16% per annum. So to show this, the two accounts which is involved is fixed deposit, and you need to be specific. What is the bank's name? It is Lex Bank. And we took money out of our bank account. That's why bank is credited, the rest is debited. So the fixed deposit is regarded as a non-current asset. It's a long-term asset. They said we've invested this for 24 months. That means that our assets is going to increase and our assets is going to decrease. Received money from our investment in our fixed deposit. So what is happening now? We've invested money and now we've generated an income from that. We've received money from that. This will be shown as bank and interest on fixed deposit. That money will be paid into our bank account. And why did the business receive money? We've received money from interest that we've generated from that fixed deposit. That's why it is shown as interest on fixed deposit. When the business receives money, it means that bank will always be debited. Our assets is going to increase. Account credited, interest on fixed deposit, which is regarded as an income. It's classified as an income, but it will have an effect on your owner's equity. And if we look at what effect it will have, if your income increases, it will have a positive effect on your owner's equity. Received money from the tenant. So the business received money, then bank is always involved. Bank will be debited. Why is my bank debited? We cannot say tenant. When we've received money from the tenant, this will be shown as rent income. Bank is a current asset, which means our bank account will increase, our assets will increase. Rent income is an income which will affect our owner's equity. If our income increases, it will have a positive effect on the owner's equity. Now we've got paid the monthly rent. When we pay our monthly rent, it means that bank will always be involved. Why did we make this payment? Because of rent expense. Bank will be credited. It means that the rest is going to be debited. Rent expense is an expense, but what effect will it have on your owner's equity? If our expense increase on the debit side, it will have a negative effect on our owner's equity. If money goes out of our bank account, it means that our assets is going to decrease. Received money for services rendered on behalf of another business. So we didn't render a service to customers. We've rendered a service on behalf of another business. It means that the business received money. Why did the business receive money? This will be shown as commission income, and you have to be specific. If the business receives money, then bank will always be debited. The rest is going to be credited. So bank is regarded as an asset, and if more money comes into our bank account, it means our assets will increase. Income, commission income, is regarded as an income. If our income increases, it will have a positive effect on the owner's equity. Paid commission to the sales staff. So we've spoken about this before in the previous activities, and that's why you have to be specific. When we pay commission to our sales staff, it means that the more sales that our employees got that month, the more income they're going to earn. And that payment that we make towards our employees, that is regarded as commission expense. It's from the business perspective, it's an expense to the business. When money is paid, it means bank will always be credited. Commission expense is regarded, classified as an expense, but it will affect our owner's equity. If our expense increase, it will have a negative effect on the owner's equity. Again, it is so important to understand this. When our expense increase, our owner's equity will decrease. And if you think about it, why? The net profit has an influence on the owner's equity. How do we calculate the net profit? We take our income minus our expenses. So if our expenses goes up and up and up and up, it means that our profit will be less, and that will have a negative effect on the owner's equity. Bank is classified as a current asset, which means money goes out, our assets will decrease. Paid for cleaning materials to clean the offices. So when we look at which two accounts is involved here, number one, money goes out of our bank account, we've paid for cleaning materials. Cleaning materials will be shown as consumable stores. Bank is credited, consumable stores is debited because our expense is going to increase on the debit side. But how does that affect our owner's equity? If our expense increase, it will have a negative effect on the owner's equity. Bank is regarded as a current asset. Money goes out, our assets is going to decrease. Borrowed money from Sunbank for the expansion of the business. The loan will be paid back in 10 years at an interest rate of 19% per annum. So it's saying to us, we have borrowed money. That money will be paid back in 10 years, and the cost of borrowing money is called interest, and we will have to pay back that interest 19% per annum. So when the business borrows money, that money will be paid into our business current bank account. So the business is going to receive money. That's why bank is going to be debited. Why did the business receive money? We borrowed money from who? From Sun Bank. And that's why we're going to say loan, and we have to name the name of the bank. Bank is regarded as an asset, which means our assets will increase, our bank balance is going to increase. Loan is regarded as a liability, and liabilities will now increase because we owe that money to Loan Sun Bank. Now it says to us, paid the first monthly installment on the loan from Sun Bank. We need to pay back that loan, but not only the monthly installment, we also need to pay the interest on that loan. But here they're specifically talking about the monthly installment. Installment means over 10 years, because that's how long we took out the loan for. They're going to work out how much we need to pay back on a monthly basis. So the two accounts involved is bank, because we made a payment. And who did we pay the money to? To loan, and we have to be specific what is the name of the bank. Loan is regarded as a liability, and as soon as we pay back the money, it means our liabilities is going to decrease. Money went out of our bank account. Bank is regarded as an asset, a current asset, so our current assets will decrease. Now we have to pay interest on that loan. Remember, there's a difference between the monthly installment and the interest. So when we pay back now the interest, that is our expense, the cost of borrowing money. And if a payment is made, it means that bank is involved. And why is bank involved? Why did money go out of our bank account? Because we paid interest on that loan. And that's why we call this interest on loan. It's regarded as an expense to the business, which will affect our owner's equity. If our expense increase, it will have a negative effect on the owner's equity. Bank is regarded as a current asset, which means our assets is going to decrease. Paid for part of the building of a new parking area. So we've now built a new parking area. So when we build any additions to our properties, this will be shown as land and buildings. It will increase our assets. Money was paid from our bank account. It means that bank will be credited. Land and buildings and bank is regarded as an asset. And to be more specific, land and buildings non-current asset, bank is regarded as a current asset. It means it will increase and decrease our assets. I hope that you have a better understanding in identifying which two accounts is involved. A reminder, when we're only looking at cash transactions, what we're doing now, it means that bank will always be involved. So you can literally go and study what happens if money comes into our bank account. Bank will always be debited. And then we just apply the double entry principle. It means that the rest will be credited. So ask yourself, why did the business receive money? That is the second account that is involved. The same goes if when payments are made, bank will always be credited. Money will go out of our bank account. Why did money go out of our bank account? And that's what you need to ask. And that's how you identify which is the second account which is involved, because we have to apply the double entry principle. Then our next step is classify each account. If we know which account is debited, which account is credited, what do we classify that as? Then we can understand, but will it increase or decrease either our assets, owner's equity, or liabilities? Lastly, remember, my accounting equation consists out of assets equals owner's equity plus liabilities. This is the basic format of the accounting equation. So when we're looking at income and expenses, we say that all income and expenses has an effect on the owner's equity. It will either have a positive effect or it will have a negative effect. I want to leave you with this quote. Success is not final, failure is not fatal, it is the courage to continue that counts. I hope you have a wonderful day.